Are payroll audits common for foreign companies? What payroll audits are looking for? A payroll audit is not a general fishing expedition. It has a pretty focused goal to check whether what you paid, what you withheld, and what you remitted line up with the rules. Auditors look at gross pay, overtime, taxable benefits, vacation pay, income tax withholding, CPP and EI contributions, and the timing and size of remittances. For foreign companies, the core question is whether you are being treated differently or looked at more often just because you are not local. Why foreign employers catch attention? Foreign employers are not automatically audited more often, but they do attract attention when something looks odd. Late or missing remittances, big mismatches between T4 totals and remitted amounts, or employees reporting income without matching employer slips can all prompt closer review. Cross-border setups are more likely to have those mismatches simply because there are more moving parts. US systems feeding Canadian payroll, remote staff in multiple provinces, and occasionally partial or delayed registrations. Common triggers that lead to audits. Several patterns tend to trigger payroll audits. One is a history of late remittances or penalties. Another is sharp changes in payroll levels with no clear explanation, such as a sudden drop in remittances while reporting similar headcount. A third is complaints or tips, often from former employees who believe they were misclassified or underpaid. For foreign companies, misclassification of contractors is a particularly common issue. When someone treated as a contractor files taxes as if they were an employee, the system sometimes notices the mismatch. Why audits feel harder for non-residents? When you are local, you usually have in-house people who know the system and speak the same shorthand as auditors. As a foreign employer, your internal team may be learning Canadian rules as they go. That makes audits feel more intimidating. Nothing in the law says auditors must be tougher on non-residents, but the communication gap can make the process longer and more stressful. If your documentation is thin or scattered across systems, that adds to the pressure. Scope and depth of a typical payroll audit. In a standard payroll audit, the auditor will select a period and review several pay cycles in detail. They will check the math on pay, verify deduction calculations, and compare remittances to what should have been sent. They may ask for sample contracts, timesheets, benefit plan documents, and explanations of how you classify roles. If they see issues in the sample, they may expand the scope to cover more employees or a longer time frame. For foreign employers, the sample often includes cross-border roles, interns, and high overtime positions because those are common trouble spots. How foreign companies can prepare before they are audited. You do not have to wait for a letter to act like an auditor. Running internal reviews of your own payroll is one of the best ways to reduce audit risk and impact. That means checking that employment contracts align with actual pay practices, confirming that your payroll setup calculates CPP, EI, and tax correctly, and verifying that remittances match system totals. It also means looking hard at contractors who only work for you and asking whether they still look like contractors under Canadian tests. The role of Canadian advisors and providers. Most foreign companies do not handle Canadian payroll mechanics entirely in-house. They use local providers or advisors. That is fine, but it does not transfer responsibility. If an audit happens, you want those providers at the table with you, helping explain calculations and produce records. At the same time, someone in your organization should understand enough to follow what is happening and challenge anything that does not look right. Blind trust is not a strategy. What happens after an audit? An audit can end with a clean bill of health, a short list of recommended improvements, or assessments for unpaid amounts plus interest and penalties. When auditors find issues, they may project them across multiple years, so even small errors can turn into meaningful numbers. For foreign employers, the key is to treat findings as a map of what to fix, not as a reason to pull back from Canada. Adjust your processes, correct the underpayments, and move forward with better systems. Are payroll audits common? Payroll audits are not constant, but they are normal. Foreign companies are not automatically at the front of the line, yet they are more likely to have structural weaknesses that audits uncover. If you register for payroll, hire staff, and grow your footprint, you should assume that at some point someone will want to look under the hood. Thinking of audits as a routine part of doing business rather than an exceptional event makes it easier to put sensible controls in place. Final thoughts. Payroll audits for foreign companies are neither rare nor inevitable punishments. They are a normal tool the system uses to enforce rules. What makes them painful is usually not the fact of being audited, but the quality of your records and the design of your payroll process. If you build Canadian payroll with documentation and internal checks from day one, an audit becomes an inconvenience, not a crisis. For more practical ideas on how to audit-proof your Canadian payroll without overcomplicating it, you can explore resources at www.theaccountingandtax.com. If you require assistance with Canadian tax matters, our team is ready to provide reliable professional support. Please contact us at 416-283-8774 or visit theaccountingandtax.com for more information. And if you found this video helpful, don't forget to like, subscribe, and share.